Now we get to pivot abroad, and we get to look at what does the U.S. exports look like, what is happening in the global construct. And again, we'd like to remind you, please like, share, subscribe. Your comments are always welcome. We've had some good dialogue in the comments, so we'd love to hear from you again. Just getting into U.S. data points. So the gasoline number, a nice little increase of 216,000 barrels a day. We're seeing some of that demand increasing, specifically in Brazil and some of the some other Latin American countries. But again, it's just going to be we're still down year over year, 5-year average. So it's not that we're going to see another big increase. And at the same time, there's going to be those timing delays as we have, some of the things we're already exporting, and the delays on getting ships back. Distillate is going to continue to struggle. It was down 134,000 barrels a day. As we've been talking about, there is so much distillate out there. And if Europe is exporting it to the U.S., then that means that they're able to export into other regions. Russia has had some weird shipments. I mean, we actually have gasoline coming from Europe and going all the way to California, just to give you an idea of just how glutted the market is right now. But when we look at propane, it was only down 174,000 barrels a day. Again, that's something that we think is going to reverse and go higher as we continue to see demand into South Korea, as well as China and some of India, but South Korea and China are some of the big ones. And just to pause here for a moment, we cover that in great detail in the end of year report coming out this week. So please let us know. We'd love to send you some table of contents, some samples, just so you get an idea of, we cover NGLs in depth from a company level, an infrastructure level, a demand level, as we look at refining petchems around the world and how things are shifting. And then obviously China is a big part of that. So we have a big deep dive in terms of China over the next couple of years as we had the new plenum and the shift into the dual circulation system. So the last part is obviously oil exports, huge drop from 3.45 into 1.8. So we had a drop of about 1.6 million. This is a mixture of two things. One, you have your issues with the Houston Ship Channel getting shut down for a day and a half. But we also also gets very interesting in Pad 3, specifically on a storage level, because this is when the tax man starts to come around to count barrels that are still in and then get taxed on those barrels. So we typically will start to see some movements. So I would expect to see this increase. Again, will it go back to 3 million? Most likely not, just because of the timing delay. We were expecting to go from 3.4 to about 2.7. Here we went to 1.8. So off by about 1 million. But again, the weather was the issue. So we think that there will be that snapback, but it's not going to be something closer to 3. The bigger thing is as well, we continue to see a lot of demand coming from Alaska and the North Slope heading into China, which has been a fairly big pull on U.S. crude oil exports. So just looking at some of the dynamics, as we said, we thought gasoline was going to continue to trend above that 9-year average. You can see that we normally get a decent spike at this time of year, looking at the 9-year average, but also looking at the top of that cloud. As we said, it wasn't going to reach the top of it, but it was going to still remain fairly elevated. And it's something that it'll drop, but we're not coming back to the 9-year average. It's still something that's going to remain well over that 9-year, 5-year pace, just because there is that demand out there. And we do have a lot of gasoline at this point, and we're trying to move it back into the system. So then as we go a little bit further into distillate, as we were saying last week, we thought we were going to get a little bit of a bounce and kind of stay within this fall out of the cloud, but again, not see this kind of drop. So this is something where we'll see a little bit of a bounce, but it's still not, maybe we get back into the low end of the 9-year average, but it's not going to be anything sustainable to this back to the average, just because, again, demand remains weak. There still remains a lot of product in the market, which we'll talk about with Fujairah, Singapore, and in parts of Europe, which is going to keep some of this flow and really kind of keep a lot of this stacked, especially because Europe is pulling less distillate from the Middle East, from Europe, from Asia, which again is really kind of stopping and filling up, and you're seeing it now reverberate back through the system, which we'll talk about in pieces as we think about how Europe not buying is having this reverberating knock-on effect. Now, as we look at oil exports, you can see that, where we sit versus since 2015, again, obviously 2015, 2016, we're starting to come into our own as the export ban is lifted. And we're kind of in the middle of nowhere. Again, this is more weather related and less demand related. So we will see a snapback, but it just won't be to the same level just because the spreads are conducive to buy oil from the U.S. now, but these are things that won't get filled until either the end of this month, next month, into January ready, and see that delivery. The other thing that we've talked about, and it's worth mentioning here, was the dollar versus euro. As we've been saying, as we head into the ECB meeting tomorrow, there's going to be pressure on the euro, and Lagarde is going to push to try to bring and soften how the euro has strengthened. And by doing that, we should see an inherent bid in the dollar, which, as we look at, maximum longs in the euro, maximum shorts in the dollar, typically means that we're going to get some sort of correction. Now, again, we're not saying the dollar is going to 100, but we did get to about 90.5, and now we're at about 91.12. So we have had a little bit of a bounce, which again is going to put a little bit of pressure and kind of keep some of that oil pricing capped. Now, this is something that we talk about in more detail in our NGL report, so we're not going to go too in depth in that end of year. But this is just looking at South Korea, Japan, as we look at the RCEP trade deal. So Chinese import tariffs on oil and chemical products from South Korea and Japan specifically range between 80 basis points to about 8%, which will gradually reduce to zero over the next 20 years. So we're not getting a huge snapback. This isn't something that is going to immediately come through. It still has to get approved, but this gives you an idea of where stuff comes from. So you can see South Korea exports a significant amount into China on light cycle oil, para-ethylene and polypropylene, and propane in general. So you can see that there is this demand, and Malaysia is also a big part of that. And with Malaysia losing some of the imports into Australia, Malaysia is going to have to find a new home, which again is most likely going to look at the Chinese imports, because these trade flows are looking at exports from South Korea, from Japan, Singapore, Malaysia into China. So it's going from what is China importing. So you can see that those two pieces are very big. Now, when we look at the increase in Chinese buildouts of chemicals, and a lot of these units are essentially married refiners and petchem, so that they can try to maximize not only feedstock but also end stock to try to limit some of their needs. But they still do need feedstock. So the light cycle oil, the para-ethylene and the polypropylene will continue to move. Bitumune is going to be some, mixed aromatics. All of these things, while there'll be less demand, there'll still be a demand, and that's why we're seeing some of this. And it's just interesting to look at. Now, when we look at LPG tanker surge, this is showing you the increase of exports from the U.S. into the international market. And this is just looking at tanker rates of the Mideast into Japan, just to give you an idea of the moves and why we're seeing additional flow, because Japan is buying more from the Middle East, which again is taking away Middle East flow into India and whatnot, which is why we're backfilling. So you can see the rates just continue to move higher. And then when we follow that through, U.S. LPG exports to China, again, record levels. It's something that's going to continue to move to the upside. Now, this is at a record level. It's going to stay elevated. It won't continue to kind of drift higher, just because, it's a seasonal game as well. And the seasonal, we have a seasonal move. And then as the seasons start to normalize, we'll kind of go sideways. But again, the demand is there. And that's why when we look at LPG, when we look at NGL demand, LPG is going to be a big driver off from exports into the international market. So as we look at Fujairah, again, looking at kind of those knock-on domino effects, the total stood at 23.1 million barrels as of December 7th, which is the highest since September 14th. Again, we're starting to see these increases again, and the increases are really being driven, as you can see here, light distillate, heavy resid. So heavy distillate, which is including fuel for a power gen, bunker, was up 18%. Middle distillate, which is jet fuel diesel. Again, when we the reason why we get concerned is, and the one that we focus on the most, is when we look at that middle distillate, which is the jet fuel diesel, because that is where we're seeing some of the slowdown in demand. And then the gasoline, naphtha on the light distillate side was up 3%. So it's the first time that we've seen an increase across all three categories since August. And the problem is on why the builds are important is because exports of all three categories have gone down. And it's the slowest in recent months. And according to Kepler, for November, just looking back, 96,000 barrels a day middle distillate was headed out of Fujairah, which is down from 137 in June, while 213,000 of fuel oil was exported, which is down from 282 in October. So again, we're seeing the pressure overall as the demand continues to we're seeing a management of storage, which is putting more within Fujairah. You can say, obviously, we're not back at June levels, but the trend is heading back in the wrong direction. And it's something that's going to continue as we see Fujairah and the UAE in general are talking about another refiner, again, trying to move down the value chain to limit the exports of oil. Now, we covered this in the OPEC show to a point, but we wanted to reiterate, this week, the deal overall, again, the deal just legitimized the cheating. So we shouldn't see a huge increase in January. It just means that what they were producing now in November and December is just okay. Russia, Saudi Arabia are allowed to increase their throughput of 131,000 barrels a day. Iraq, 55. UAE's 38,000. And that's the bigger one because the UAE is the one that really wanted to see those increases, and they've already pushed through some of them. So we will see them overproduce in December. But given where we sit in terms of total demand and total flow, it's not something that we think will be limiting as we go into the end of the year. And the reason why is because, the OSPs were sent higher. So it's interesting because Saudi Arabia increased the light official selling prices, which just means that we'll see selling prices can move up for everybody as we go through the remainder of the year, as we get new updates into the end. And the problem is, this is going to hurt refinery margins. So refined margins are getting hurt. We're seeing that pressure overall, and that's going to continue through the end of the year because we did get a little bit of a saving grace in some of the refining numbers. Some of them actually flipped positive for the first time, but this is going to weigh on overall purchases. And but at the same time, we're starting to see a little bit of a slowdown in Chinese purchases. We did get a wave of purchasing, and it continued into the end of November. And now we see some additional purchasing coming from India and less from China, but we'll go through that in a bit more detail. So we showed this before. We're just going to reiterate it again. This is the numbers that we calculated coming out of the OPEC agreement. Again, the reference output, it's elevated because it was off of very high numbers. So that's why when we talk about the March, the March production and then the new cuts. So when we look at January production, it's the first time that we're actually going to be over 25,000 barrels, and it's really driven based on Libya. Libya's come back aggressively, and that's why we continue to see some of these increases overall, which again is going to push additional barrels into the market. But right now we've seen a fairly strong purchase of West African crude, specifically Nigeria, into Europe. We've seen some Libyan crude that was sitting in Malta getting sold into the market. That is now getting replenished with new exports. But again, it's just going to be a timing delay as to when that really does show up. And that's when we look at overall output. So when we look at November, everybody has us at about 25.2, 25.3 million barrels a day of exports coming from OPEC, which is the biggest that we've seen. And again, really driven by Libya. And when we look at December into January, it's important to see that Nigeria's cut back a little bit, Angola, a slight increase. The biggest increases overall, the ones that we want to point out, is obviously Libya. Libya is going from, in August and September, about 100,000 barrels a day to 1.05. But it's also Norway. So Norway's seen an increase of about 200,000 barrels from November, December into January, and they let the cuts expire. So we're going to see more coming from Norway overall, which again is going to sit within floating storage. We have seen some of that floating storage move into China as the purchases, as we talked about. We did get a wave of purchases, which is now why we have some of this stuff going from floating storage into oil in transit. It's just a matter of where do you recognize it. Now, initially we recognized it in floating storage. Now it's oil in transit. And then the question is, will it become Asian floating storage, or will there be enough spare capacity to move this on shore? When we look at Libya, just to comment real quick, there still remains an infighting as to what to do with the revenue. Again, because there's no real proxy influence, we see the ceasefire holding. Again, they need capital. It's that simple, and that's why, like, even if they're not happy about it, there's going to be a fairly stable movement going forward to try to come to some resolution without additional shutdowns of production, because that capital is so important. And now, when we look at the UAE, they've already given indications to their Chinese buyers that they're going to be selling more. You can see that November, they had the cuts in October to make up for August. They were not happy by the commentary that was made to them by Saudi Arabia, and they made that known, which was a part of why we did get an increase of 500,000 barrels a day in January. And so far, the goal is to be 500 in Jan, and then 500 every month into April to see a new 2 million barrels a day come into market, not including Libya. So now we're starting to see those increases in November. We've already gotten indications of more flow coming in December, and that's only going to, so they're essentially going to enter January already producing at that number. And it'll be, again, what did this OPEC deal do? It showed that if you cheat, there's no repercussions, and that's why I think you're going to start to see more oil bleed out from these countries, especially the UAE. Now, we talked about some of that. Now let's look at some of the bright spots. Brazil continues to be a big demand area. Now they can also consume their own oil. So this is looking at demand for gasoline and ethanol overall. And when we look at it, we're back to the pre-virus levels. And what does that mean? So refiners processed 1.85 million barrels a day of crude in October, which is a 17% increase. And they're doing it from themselves. There is a little bit of an increase in exports, but again, most of it is being consumed domestically. So the benefit is, as more is consumed domestically, it means that there's going to be a little bit more of an opportunity for the U.S. to export more gasoline as this stays within Brazil. And overall, they've also had a strong diesel demand because, again, diesel is being used for a very strong, planting season, demand season. Again, China was buying a lot of grains from Brazil, so it's not surprising to see a big increase in diesel demand as well. But this just means that there's going to be less exports, which is going to help move some of the glut around. But because of Europe having so much, it's just they can feed that down. Instead of it going to West Africa, it can go into Latin America, and we're starting to see some of these normalizations overall. Again, there's a lot of product to move around, and we're just seeing it go into different areas. But when we look at the general hubs, we continue to see builds overall, which is, again, kind of that net negative, and is going to be that overhang because, yes, oil may be drawing down, but it's resulting in an increase in builds of refined products. And the problem is a lot of these areas already have very low refinery run rates. So you're getting refined product builds with run rates low, and yeah, they're running more crude or they're pulling crude through, but at what point is that you're gonna have to have that little snapback, which is just gonna be that overarching problem that we see as we look forward. Now, with that being said, worldwide crude floating storage down again. Now we're down to just under 100 million barrels as of December 4th. So just to kind of give you an idea of the timing of this. So you can see, obviously, we're still higher than last year, but we're down to the levels that we've been to since April. Now we're down 15% overall, which is obviously a positive. Asia is down 13% at 67 million, which is the lowest since May. Europe down 30%, Middle East down 7%, North Sea down 52%, West Africa, which is the big one, which we'll talk about a bit more, down 81%, and Gulf Coast up small. Now, what is happening and what does it mean overall going forward? And when we look at China, for an example, so November crude imports were at 11.08 million barrels a day, which is versus October, which was 10.06. So we essentially had an increase of 1 million barrels a day, but in November of 19 was 11.18. So we're about 100,000 barrels down year over year, but we're about 1 million barrels up month over month. So again, it's a little bit of a bullish move. Some of this is going into onshore storage. Some of the issues that we're seeing now is these hidden barrels or these missing barrels. So there's about 980 million barrels that are missing if you factor in imports versus what refinery runs are doing. And where is it going? And it's going into storage. So when we look at China, for an example, because we've talked about it many times, China has about 70 million barrels of storage that came online. They are going to try to fill that and try to get the best pricing they can. So clearly they've gone out, they've increased their purchasing, and they normally increase purchases ahead of Lunar New Year. So when we look at, okay, well, what does that mean in terms of Lunar New Year? Well, let's look at crude oil on the water. So crude oil on the water has increased. Crude oil in transit has increased. We're back now to levels that we haven't seen since, essentially going to the beginning of the summer, really middle of the summer is where we're getting back to, and that's trending higher. And typically we get an increase in oil in transit, and then we'll get an increase in floating storage. Now, the demand is picked up in Asia, so we're not going to get the same level. Like, we're not going to get the same builds. It's just the pace is going to flatten, and then we're going to start to get some increases, and it's going to marry with Lunar New Year and the slowdowns within Asia in general. So that's why when we look at it from a Chinese perspective, we have to say, okay, well, let's look at the preliminary reports. So right now, crude imports on a 1 million ton level, crude imports were 45.36 for November 20th. So then what were oil product imports? So oil product imports were down 14%. So oil product exports came down versus November, but again, they're still down from October. Now, this is interesting because we were seeing something that was a little different, where we saw an increase in exports in October into November. So again, this is preliminary, but typically this isn't all that wrong. So it means that we will get a nice surprise to the downside in terms of exports from the market. Why did we see that? And this is where things get interesting. We actually had state-owned enterprises, instead of making the refined products, they were purchasing the refined products from the teapots. So we had less exports and actually turning inward, and we had imports, from the teapots into the SOEs because it was cheaper to buy it from the teapots. The margins abroad still are very weak. So if you're a teapot or if you're an independent refiner, why am I going to sell it abroad when I can sell it internally? So that's where we saw some of this movement. And it's just something where when we look at it, so, typically we're down about 1% versus last year. And this is going to be something to watch, and then it's going to be interesting to see what India does. So when we look at this, Asian floating storage, again, we're seeing this drawdown, but Asia is obviously incorporating a lot of things. So capacity in India, as we were talking about, was 87% in October, which was 86% in the previous month. So a small increase overall. But October runs were lower versus the previous year when we start looking at it, that they were at 104%. And instead, the state was about 89%. So runs overall were still about 83% down. The private refiners were about 80% versus 103% last year in September. So again, like, you're seeing kind of that slowdown overall. It's still an increase from where we were. I mean, we were down at 50, 60, 70%. So an increase to 80%, 85% is a positive. But just to put it into context, we're still down about 20% year over year, which is, again, going to put a little bit of a pressure, because we see demand slowing a bit, not aggressively at all in India, but again, we still see it slowing, which is just going to keep some of their demand down overall as we see some of those builds in product. Now, when we look at the North Sea, a lot of this drop down in floating storage, most of this is going to China and Asia in general. So but again, as we see the loading schedules, we're going to start to see that build back up. Something to watch as it did come down in a positive fashion. West Africa, we got a big knockdown as we did see West African crude, specifically Nigeria, get pulled into Europe. We did get more into Asia from Nigeria. But again, those were just floating cargoes that were sold at a discount to get them through the system. OSPs are going to go up. So then the question is, are there going to be countries in general that are going to kind of hold off and let some of the pricing normalize? I would say yes. So this is something that I'm expecting to kind of follow more of the average to the upside. The other issue is going to be, where is the demand overall, and what kind of crude is getting demand, is seeing the type of demand that we're expecting. And Nigeria does have some grades that will see some of that growth. But, like we just saw before, Spain was at a 9-year low in terms of their imports. So we did get some imports. Some of the Libyan crude went into Italy, went into Spain. Some of the Nigerian crude went into Spain and other parts of Europe. Again, this is something that is going to start to slow down, especially because we do have some builds in European oil month over month. And then this is an interesting one because Middle East remains elevated. You can see that typically there's a drawdown, but the drawdowns have been fairly slow. And it really comes back to more Basra crude getting pushed out. We did get a small attack in Kirkuk. 2 wells were attacked, which totaled about 2,000 barrels a day. Obviously 2,000 barrels a day is not a huge number, but it's just how much instability is starting to come in, how much of that risk premium needs to get priced in based on where things are. A lot of that crude is still in the southern part of the country. So when we look at Basra, we have increases in flow. When we look at UAE, Saudi Arabia, we are seeing an increase. And the problem is we're seeing an increase into January as floating storage remains elevated as we compare it to the last few years. Again, not at 2016 levels, but something still elevated. Then when we look at Europe, so the Europe 16 nations oil inventory fell by 2.7 million barrels to about 1.2 billion, 1.178 billion in November. Now, crude had an increase. So crude increased 370,000 barrels. The drawdown was really middle distillate as we look at the aggregate overall. So middle distillate had a draw of about 3 million barrels as we saw. Again, the middle distillate just transferred from Europe into the U.S. But we still see that, European oil remains elevated on a floating storage level. Things remain elevated onshore, which again is just going to keep some of this, and we think that we're going to get another spike to the upside. This is looking at things on an aggregate level. So we got a draw pretty much across the board based on the Insight Global. And again, this is last week. It updates tomorrow. But you can see on a gasoline level, we're still well above normal. We have seasonally adjusted all-time highs, which is why gasoline exports will continue, and that's going to keep pressure. Even though we have Brazil as a bullish backdrop, it's still going to get filled. The U.S. would be happy to export more gasoline, so there's going to be more than enough to fill the void. Gas oil is much closer to that average, but just given the trend overall in terms of heating demand, industrial production, lockdowns, in order to try to keep and manage this number, we will see the exports remain elevated, but we will also see imports drop, as we've already seen coming out of India, Singapore, which is leaving more product in Singapore. So this chart here, so again, this update's on Thursday. This was an increase of about 2 million barrels week over week. And you can see here that this is the total. So you can see the bounce, seasonally adjusted, all-time highs, again, remaining elevated as we get this knock-on effect and just this backdrop of more stuff getting left on the water on a product level, which is just going to be a longer-term overhang for normalization in oil demand as we start to see supply come back. Now, this is looking at middle distillate. Again, we like to look at middle distillate. Everyone classifies it differently. The trend is up. We had a little bit of a drawdown. That's starting to refill. And it's really because China is pushing more out, and China's demanding less because they're supplying themselves more as we get movement. So again, this is why China is a big backdrop and a big focus of our end of year report, as more refining comes online. So they're going to naturally need more oil, but they're going to have more product to move around. And if they're importing less product, that means there's less product, there's more product in the market, and then they're going to export more, which means that even though they're importing more oil, somebody will be importing less oil. And we're going to see a shift in the way refiners are essentially moving product, moving oil, as the shipping lanes continue to adjust. Now, when we look at light distillate, you can see that this is at least in some sort of comfort level. But as we see gasoline flows start, especially in the U.S. and Europe increasing, this is going to start to flatline. It's not going to increase just because we do have demand in India, we do have demand in China. So this is not something that is going to spring back to the upside. It's just going to kind of go sideways. And as you can see, it on a seasonally adjusted level, that normally happens. So it's, again, nothing crazy compared to seasonal, but on the 20-year average, we're still well above the 20-year normal. Now, this is the interesting one, because when we look at China in terms of the total numbers, so the refined run rates are still averaging about 70-74%, depending on where you are. Obviously, there's some increases of 84% in South China, but for the average, we're much closer to about 74%. And we still have independent refiners running hard. They're at 75%. Again, coming to where a lot of this flow is coming from. So combined stocks of gas oil and gasoline fell 61.9% on the month to 470,000 metric tons in November, the lowest since January 14. Again, moving product from the coast and the teapots into the state-owned. And this comes as major oil companies Sinopec and PetroChina started to procure oil products from Shandong independents versus other. And this was despite independent refiners increasing their combined output of gas oil and gasoline by 6.6% on the month to 8.367 million tons. For gasoline, output increased 15.4% on the month. And again, it's just a matter of direction, as instead of this going out into the market, it's being turned and going inward in order to kind of balance out some of this market, which is why there's more opportunity for the independents to import more crude, which is what we're seeing. We had a drawdown. Now we're back up to about 44, almost 45, 44.94 million barrels a day in storage. So again, China's going to be an interesting one just because their data is questionable at best, and we're trying to manage it. China is the buyer of choice. We're watching them closely because we are seeing some interesting shifts. And as we get closer to Lunar New Year, which is what we're going to talk about in more depth in segment 5 of the Econ Show, we're going to look at how is Lunar New Year going to impact exports, imports, and just general demand, because it's going to be an interesting one going forward. So thanks again for watching. If you have any questions, please reach out. We love feedback. And as a reminder, our end of year report is available. Please reach out for table of contents, samples. We'd love to hear from you. So again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.